Well, good afternoon, everyone, and welcome to this PARC event on fair reward policy. What does it mean and how is it changing? And all of us aspire to have a fair reward policy, but in practice, it's very challenging for us to deliver. So to share some insights on this, we have a distinguished panel from a variety of backgrounds and perspectives. Celia, Peter, and I are here in one room, socially distanced, and Torsten is safely at the other end of a fibre connection. To start us thinking about this important topic, we've invited George Feiger, who's the Executive Dean of Aston Business School, to set the scene for this afternoon's discussion. Now, earlier in his career, George worked for McKinsey and in banking and in venture capital before moving into academia. Sadly, George can't be with us today, but he was kind enough to record for us in advance his thoughts. So let's hear them now.
So hello, everybody. We're here to talk about how much to pay the bosses. Now, how leadership pay should be set for the chief executive, but also for top management generally, has become a top agenda item for businesses, for investors, and for politicians. In the popular perception, it's particularly pressing at a time of economic and social crisis and the recognition of widening inequalities in our society. But this is far from a new issue. We've experienced decades of accelerating increase in leadership pay relative to median employee compensation or any similar metric. For a company, excessive pay is money taken from the shareholders, the owners of the company. In a broader social perspective, the existence of a class of people considered to be receiving grossly unfair compensation undermines popular confidence in the entire economic system. As I've said, this has been discussed many times before. In our capital markets, and I'm hardly the first person to say this, there's a separation of ownership and control, where company owners are a multitude of individual shareholders and pools of shareholders, also known as fund management companies, none of which has the ability or the willingness to delve deeply into how well companies are run. This has been seen by academics and many others as allowing the capture and looting of companies by their managers. Okay, but we do have to pay leaders on a sensible basis. The idea that the reward of leaders should be related to the value their decisions add to a company is not too controversial. The problem arises from how that value added is measured. From the perspective of hiring and compensation committees of company boards, this difficulty extends to how value added is not just measured after the event, but incentivized in advance. I know from my own business experience that the gaming of incentive systems is a really important management discussion topic. So the problem is very real. Now, not everyone, particularly in the well-paid part of the business community, agrees that there is a problem. So we need to get some red herrings out of the way. It's easy to identify a Branson, a Dyson, a Musk, a Bezos, and say that clearly they deserve their staggering rewards given what they've created. But this is irrelevant. These are extraordinary entrepreneurs. Their rewards are overwhelmingly in the equity of businesses that they've created. Their compensation says nothing about what one pays the ordinary, board-appointed leaders of long-existing companies. It's also sometimes argued that leadership rewards have more or less risen with company values. For example, at the rate of increase of the value of the S&P 500. So this increase in company value justifies the pay that the leaders receive from the shareholders. But a stock price rationale for the extraordinary increase in leadership rewards over the last few decades is on particularly shaky ground. Let me give you the key drivers of stock price increases over the last few decades as I see them. First, as any financier will tell you, the primary driver of the increase in overall asset values for the last several decades has been the secular decline in interest rates. This might justify higher pay for governors of central banks and for treasurers, but it says absolutely nothing about company management. Then, Western economies have seen a relentless increase in industrial concentration, where competitive industries have turned into oligopolies. Oligopolies generate more profit than firms in strongly competitive markets. And the exploitation of customers might be seen as a shrewd move by company management, justifying higher pay. But in a more effective environment for competition regulation, such returns would shrink mightily. You can see the backlash against the tech platform oligopolies building now. Then, as many have commented, the share of income going to capital or industry leaders relative to the share going to labour has been falling for decades. There are many causes for this. Technological innovation has displaced workers in manufacturing, for example. Economic growth has been in sectors where workers have been difficult to organise into unions. However, in my view, the single biggest factor was the collapse of socialism and the absorption of the formerly communist bloc into the world market economy. The former Soviet Empire had many millions of educated workers, but low capital stock. As they entered the world economy, the ratio of labour to capital rose with predictable results. The move of China from workers' paradise to a kind of authoritarian market economy transformed both China and the world. Western companies outsourced all sorts of manufacturing to China, which has become the workshop of the world, something I might say, a title I might say, that was once earned locally. Companies made more money, Western workers relatively less. All of this is very real, and the stock price and the profit growth are real, but they don't primarily reflect the extraordinary skills of the management of your everyday PLC, and they don't serve as any serious justification of the levels of pay that we see. Indeed, looking at our country, looking at the UK, the message might well be that pay should have been lowered rather than raised over the last few decades, given what has happened. Let me list this for you. First, productivity growth in our country has lagged the best performing countries for decades. Second, despite the world-leading intellectual capital and the world-leading universities that we have, there has been a very notable shortage of commercialization of ideas compared with the other intellectual powerhouse, the United States. As an industrial example, before the pandemic, the UK auto industry was having some of its best years in terms of production and exports. But that, of course, is because all the major companies are now foreign owned. And as an infrastructure example, as you work from home, how's your broadband relative to South Korea? I could go on with this. At Aston, we work with many companies in attempting to enhance their management ability, but enough said. So, where does this leave us in attempting to set executive rewards? We need to examine both the process by which leaders are appointed and their terms are set, and the metrics by which we judge their accomplishments. The process is suspect. We use recruitment consultants who get paid a percentage of the appointee's salary. It's an interesting incentive system. I spent many years in the finance industry. Bond rating firms were paid for the ratings not by the buyers, but by the issuers. Is it any wonder that many highly rated bonds collapsed in value? Boards, especially of larger firms, tend to be drawn from the pool of people who run or have run similar firms and their lawyers, consultants, accountants, and other advisors. Are they likely to be tough on each other's compensation? I know this is a tough call. After all, these are the people most likely to understand the businesses on whose boards they sit, but that doesn't make the problem any less real. The metrics are even harder to get right. Increases in share prices are a bad metric. They're subject both to short-term manipulation and, in the longer term, to those macro forces that I listed above. The outcome is more like a casino than a management project. And again, accounting measures of profit can be manipulated for many years. Look at GE, once considered a paragon of good management. So, there we have it. It's my good fortune that I don't have to propose solutions to these problems because we have a very distinguished panel of experts to do so instead. Thank you.
Well, many thanks to George for that thought-provoking introduction. As well as chairing this afternoon's proceedings, I'm going to add my own perspective on this subject. I have spent my executive career in the retail sector, including 11 years as an executive director and CEO in 2 FTSE 250 companies. I've also spent 25 years as a Remuneration Committee member and chair, including a period of time at a FTSE 100 company. So I've spent quite a lot of time grappling with these issues. I'm also chairman of the Remuneration Consultants Group, who oversee the code of conduct for remuneration consultants, which is a neat segue into introducing our first panel member. Peter Boreham is Mercer's UK European Practice Leader for Executive Award, based in London. He has over 20 years' experience advising the Remuneration Committee and management teams of major companies on executive compensation matters. So, Peter, over to you.
Thank you very much, Alan. Good evening, everybody. The trouble with the word fairness is it means different things to different people at different times. So I thought I'd just start off by looking at what fairness means and has meant in the area of executive reward. And if we go back to ancient histories, 1940s, 1960s, it was all about what's a fair rate of pay for doing the job. Starting off with job evaluation, how does one job get paid more than another because the responsibilities and skills are higher? And then more sophistication with pay surveys. How does our pay compare to the pay of executives in other companies? And that carried on for a relatively benign period, several decades. And then in the 1990s in the UK, we suddenly started talking about a different version of fairness. It wasn't just fairness relative to my job, it was about fairness relative to business performance. We'd had performance pay for a while, it'd been knocking about, but the numbers were quite small and the approaches taken were quite unsophisticated. But during the 90s, we had a series of corporate governance reviews in the UK. We had the entry of executive compensation consultants into boardrooms giving advice. We had the first little bit of interest coming in from the corporate governance community. And so the question came, not just what's a fair rate of pay for the job, but what's a fair rate of pay for the job given the performance that has been delivered. And that was an interesting time to be a comp consultant. I started doing this in 1997, and it was interesting getting to grips with how do we recognise and reward performance? And that's still the most interesting part of my job. In the early 2000s, the word fair came up a lot, usually on the lips of a CEO who staggered into the Remuneration Committee carrying a stack of annual reports from peer companies, self-identified, where the other CEOs seemed to be getting paid more than he, and it usually was a he, was getting. And it wasn't fair because he was clearly at least as gifted as these other people and yet seemed to be paid in the lower quartile. That wasn't the best part of my career, it's fair to say. But something else was interesting happening in the early 2000s, and that was the emergence of best practice as defined by corporate governance practitioners. And so their fairness was about, well, are these contracts fairly structured? Is the structure of pay fair in terms of what executives receive relative to the experience of shareholders? And that was a good question. I think if you ask the corporate governance people today, they would admit that they'd made a mistake by focusing on the design of compensation rather than its level. But at the time, the focus was, has this been designed correctly? And to be fair, a lot of abuses were tackled. I remember when executive contracts were 3 years. And so if you pushed out your CFO, he or she would get 3 years' money to go away. That went down from 3 years to 2 years to 1 year. And so the executives, for the first time, found themselves losing out. But they also won at the same time, because typically when the contract went down from 3 years to 2 years to 1 year, there was some kind of compensation. Maybe the long-term incentive award got a bit bigger. Maybe we started deferring bonuses, but not coincidentally at the same time the bonus opportunity was put up. So we had this tension between taking things away to improve how packages and contracts were structured, but then giving with the other hand. So on the whole, things were still getting better for executives. And then the music stopped. We had the global financial crisis. And the thing about that is it reset reward for everybody. In the period of the 1990s and the 2000s, when executive pay was going up, it's important to remember that most people were getting better off during that time. Real salaries were going up because of China electrical goods and the likes were getting cheaper. We had budget airlines coming on stream. And so people were able to enjoy a better quality of life. They were feeling that their standard of living was improving. And then suddenly the global financial crisis came. We had job insecurity. We had pay stagnation. We had government austerity in response to the amount that government had to spend bailing out the banks. And so the music stopped. And the question then became, is it fair to treat executives this way? Is it fair to treat them relative to employees? Is it fair relative to just societal outrage that these numbers are so big? And politicians became involved. It wasn't obvious what the politicians could or should have done to fix the problems after the global financial crisis, but it was all too tempting for them to point to some scapegoats, and typically those were high-earning chief executives. And if we're honest, if those chief executives were not in financial institutions, it probably wasn't them that caused the crisis that we were in. This focus on fairness made things worse for executives. We saw a ceiling on how much their salaries were going up. I can remember when executive salaries were going up by 10% per annum, and that then became 8, that then became 6, and suddenly, after the global financial crisis, it was 0, 1, 2, maybe 3 if you were in a hot sector. And shareholders benefited from that. It's fair to say that employees did not benefit from that. It may have become fairer, but not in a way that made things better for people. We see this clearly with the focus at the moment on harmonisation of pensions. We have pulled down executive pensions. Maybe some of those pensions were too high, but the real problem we have with pensions as employers is not that executive pensions are too high, it's that employee pensions are actually too low to produce the income that people might expect in retirement. And then in 2020, 2021, this focus on other stakeholders has gone from shareholders, employees, into a much wider set of stakeholders, like what level of government support has been provided to this business, what has happened to its customers, what's happened to its suppliers, what is this business doing to the environment. So if we move on, please. Phil asked me particularly to talk about what happened in 2020. And two sets of themes. In the governance area, various things happened that on the whole made things less favourable to executives. So we had post-exit ownership guidelines. I'll come back to those. As I've mentioned, we reduced pensions, not just for future executive directors, but for existing executive directors. And there was an even stronger focus on how we were treating the executives versus the workforce. And part of that latter point was to do with COVID. What happened to the workforce? Were they furloughed? Were people made redundant? We need to make sure that the executives were not being treated better. But there was other COVID-related stuff that typically made things worse for most executives in most sectors. Incentive plan outcomes are generally down in the vast majority of sectors. Most executives will earn 0 bonuses or reduced bonuses. Same thing with long-term incentive plans. The outcomes will be down if anything pays at all. We had temporary salary reductions. It wasn't a great year to be a senior executive. And that's normal. This is my 3rd recession as a senior comp advisor. And as with the previous 2, executive teams work harder than they've ever worked before for less pay. And it's been slightly different this time in that I think the level of empathy from management teams has been higher. The view has been, well, this is kind of unfair because I'm working so hard, but I look out the window and it's worse for other people, so I'll suck it up. There wasn't necessarily that level of maturity, I think, if we go back to earlier recessions. And I've got friends who are self-employed musicians who have 0 income. And it's an eye-opener relative to this rather gilded cage that we're talking about here. If we look forward to 2021 and beyond, what's happening here? The big thing, I think, with my clients at the moment is around putting ESG measures in incentives. So not just looking at share price, not just looking at the finances, but saying what impact are we having on our stakeholders, whether that's our customers, our employees, the environment, and probably the number of conversations I'm having about ESG and incentives is 5 times this year what it was last year. That's backed up in the survey data, and indeed in France it's now in the corporate governance code, and I suspect the same thing will become true here. We've seen more use of restricted stock because fairness. Alan might talk about that. I know you've done that, Alan, in one of your companies. But it's interesting. It's about fairness, but the version of fairness depends who you're talking to. So if you talk to an institutional investor, a corporate governance person, they will tell you that restricted share is fairer because it means the amount that a CEO can earn if things go incredibly well and they're a bit lucky is lower. And that reduces unfairness and inequality. If you talk to a participant or if you talk to a remuneration committee member, they will tell you that restricted stock is better because setting 3-year performance conditions is really hard. And sometimes it delivers a zero outcome that is perhaps a little, here comes the word, unfair. And so for completely equal and opposite reasons, we've come to the conclusion that we should have restricted shares. And I'm a fan of these in the right situation. I've got a couple of clients that have done it for executive directors and rather more that have done it below the disclosed population. We're seeing wider performance ranges because it's hard setting targets at a time like this. That's almost certainly the right thing to do, assuming it's appropriately cascaded to the wider workforce. And I think, at a time like this when it's hard to set targets, one of the difficult issues is what do you do about multi-speed businesses, where some businesses are doing very well, some other parts of the group are maybe struggling. What is a fair level of relative reward in that context? Pay equity is a huge thing. A lot of my clients now are discussing pay equity quite actively at board level or in the remuneration committee. It's not just gender anymore, we're onto ethnicity. And if I look at the work that Mercer does with its clients, we're seeing a lot more companies pulling us in saying we want a robust external analysis of whether our pay is, here's the word again, fair, given certain objective measurable criteria. We're going to see more use of committee discretion. We forget, I think, that incentive plans work really well in a relatively stable, predictable business environment. When the economic context is unpredictable or unstable, it's difficult to design an effective incentive plan without making it extraordinarily complicated. And so I think the use of committee discretion will continue at a reasonably high level for the foreseeable future. And then the last one. The separation of how we treat top executives whose pay is in the public domain and voted on versus other executives. A lot of companies have got in-flight long-term incentive plans that are unlikely to pay out in 2022 and possibly even in early 2023. And for executive directors, the advice from the corporate governance people is very clear: do not adjust the targets. And there are conceptual reasons why they would say that. But on the ground, within companies, for the non-disclosed executives, quite a few companies are actually saying, well, we will adjust the targets, or we will pay at threshold, or we will make some one-off restricted stock awards. And so we have a separation between what companies and boards want to do for their executives numbered 3 through 100 versus what they do for executives number 1 and 2. And it just raises a question for me as to whether the pendulum on governance has possibly swung a bit too far and become, here comes the word, unfair to senior executives. And I thought I'd do some analysis based on some data for this. I don't think this would live up to academic scrutiny, but looked here at what has happened in the last few years from a governance perspective. How happy are executives who've been on the receiving end of this? And then to what extent has it been cascaded below the executive director level? And to what extent has it been cascaded beyond UK listed companies? To what extent have European companies taken up these principles? And the ones at the top, absolutely, malice and clawback, executives understand it, it's typically cascaded, European companies do this. Share ownership guidelines, again, reasonable take-up, although in the rest of Europe, unless you're FTSE 50 size, you will not get an against recommendation from ISS or Glass Lewis because you don't have in-post share ownership guidelines. But as we go further down, when we get onto things like the long-term incentive holding period or post-exit share ownership guidelines, those things have not really been cascaded. Most companies have not put in place post-exit share ownership guidelines below executive director level. and use outside the UK is minimal. I do about 40 or 50% of my work in continental Europe with really quite large companies, and none of them have post-exit share ownership guidelines. In fact, only one or two of them have even debated it, and actually not for very long. So, I'm not sure if I want to come out swinging for how unfair life is for executive directors. Compared to the problems of my freelance musician friends, it's limited stuff. But I do worry a little bit about talent competition. Why would you want to run a FTSE 250 when you could be running a division of a US listed business, a FTSE 20 listed business, but you're not on the board, or indeed operating in a European listed company? Thank you.
Peter, thank you very much indeed for that tour de force, reminding us of how we got to the particular set of circumstances which are on the minds of most Remco chairs and heads of reward at the moment. So to carry on looking at the context within which fair reward policies work, I'm very pleased to introduce Torsten, who is the Chief Executive of the Resolution Foundation, a think tank that combines analytical rigour with policy prescriptions to improve the living standards of those in Britain on low to middle incomes. Now, Torsten has a background in economic policy. He worked for the Labour Party, he worked in the Treasury, and more widely in the civil service. So, Torsten, over to you to share your perspectives.
Thanks a lot, Leah, and good to be with you. And I really enjoyed Peter's reflections, particularly on the question of how you measure performance. I think in the last year it's taught us anything, it's that life has a lot of luck involved in it, and there wasn't a lot you could do if you're a face-to-face business that's found itself shut down over the last year, and there's not a lot you could do to avoid making a lot of money if you happen to be in the PPE business or indeed in the vaccine manufacturer business. And although this year is exceptional, there is a general point here about how much life has luck involved in it. Now, that isn't what I'm going to talk about because that's dangerously close to philosophy. I'm going to share some slides. What I'm going to cover is a bit different because we're an economic research institute and we focus on living standards more broadly. So what I want to do is to take the bigger question of pay and fairness of pay, and that's the context for the decisions that then you're taking about the very top who are less of a focus for the kind of research we generally do. But this is the background to that. I will do it in three sections. One is a bit of context about the crisis and the pre-crisis period, then to look at the bit that has had the headlines, which is around the minimum wage. Like if you talk about pay in the context of British politics and policy at the moment, the minimum wage is basically the fairness policy that exists. And then I want to suggest that that isn't the limit of what thinking about pay in the context of fairness should take us, and suggest some directions of travel that might take us in. So hopefully that vaguely makes sense. I shall try and stick to our 15 minutes allocated. So first of all, on the context. Now, obviously the context that you've all been seeing is the crisis we've been going through. This is from a survey that we've been running regularly through the pandemic. This is from January's wave of the survey, and it's showing you from lowest earners on the left to highest earners on the right, how many people have either lost their jobs. This is of the population that had a job in February pre-pandemic, so February last year. And what it's showing you is a very stark difference in terms of who has been affected in the labour market. And remember, in this crisis, unlike most recessions, is very labour market focused, as in the economic damage is coming through people's work. It's not coming through asset prices for a whole range of reasons. And so this is where the economic damage is visible. And what you can see is obviously that the lowest earners are much, much more likely, 3 to 4 times as likely to have lost their jobs. If you look at the black bars there, and to a lesser degree, they're more likely to have been furloughed, and they're more likely to have seen their pay fall during this crisis. It is also true that the young, it's not just low earners, the young have also been overwhelmingly hit hardest. That's often because they are the low earners, as you'll all know from most of your businesses. But if I look at the data that came out yesterday from the Office for National Statistics, almost 2/3 of the employees, so not the self-employed, but the employees that have lost their jobs since this crisis started are under 25. Okay, it's like and all recessions are worse for the young because they're the first in, last in, first out, obviously. But this, we haven't seen anything like this in terms of the concentration on the young. On low earners, it's not just that they're most likely to have lost their jobs. And again, this is showing you a similar kind of way of thinking about the labour market. So this is showing you lowest earners on the left, again, highest earners on the right. And if you focus on the different lines, they're telling you the proportion of earners in those earnings groups who are affected by different things. So the blue line is showing you how likely they are to work in shutdown sectors, by which I mean the ones that where face-to-face contact was banned. So non-essential retail, hospitality and leisure. As you can see, it's overwhelmingly low earners that are most likely to work in those sectors. That is the reason why low earners have lost their jobs. It's completely down to the sectoral impact of the crisis. It's because what's happened to hospitality and leisure has driven almost all of the labour market impact to date. But low earners aren't just most likely to have lost their jobs. They're also most likely to have faced ongoing health risks during this crisis, because low earners are the ones that work in essential face-to-face services that had to continue. Think about in the health sector, obviously, but not just that. Think about supermarket workers who carried on offering services or bin collections, all those kind of things. That's what the red line is showing you. And the yellow line is showing you what most of us are, which is working from home. Now, actually, this is based on modelling of what people said, who said they could work from home. The actual answer ended up being a lot higher. That line should actually be much higher than that. But the gradient of it is what matters. And you are much, much more likely to have worked at home if you're a higher earner during this crisis. So the effect of the crisis is very clear. Low earners, by far the highest health risks and by far the highest economic risks, not because of policy choices, but because of the nature of the crisis that we are suffering through. And again, that's not like a normal recession. That isn't the start of the story, obviously, and we can't do all of history, but I think you shouldn't discuss pay without focusing on the last 10 years, because pre-crisis, because we've never seen anything like that 10 years. So this is showing you average earnings in Britain this century, okay? And it's showing you normally the pattern you can see in the 2000s, which is average earnings going up over time. That is what we thought was normal. And when I was in the Treasury in 2008, we thought that was broadly what we would get back to by the beginning of the decade that followed. What has instead happened is the biggest pay squeeze in hundreds of years. We just got back to the 2008 levels of pay. This is average pay by immediately before the pandemic struck. So it took us 12 years to get back to the pay levels we'd had before the financial crisis. Now, there's a whole host of reasons for this, but I'm not going to go into, but that squeeze on incomes is the defining political economy feature of Britain in the 10 years before the crisis. That is why everyone feels like life was tough, that was, not unrelated to why Theresa May didn't do as well as she thought she was going to in the 2017 general election. It's not unrelated, although it's not the cause of some of the challenges about why people feel so fed up with our politics. And as you can see from the latest OBR forecast, the little blue line on the right-hand side, they're not expecting fast earnings growth even when we get out of this crisis. Although I have to say, earnings falls so far in this crisis haven't been as severe, anything like as severe as they were in the last recession. That's principally because inflation has been very low. So real pay cuts can't happen with low levels of inflation. Right, then let's touch on the good news. So the minimum wage is going through the roof. You all know this, anyone that works in any business that has low paid workers. And if you don't, you have them outsourced in your business anyway. This is showing you the level of the minimum wage since its introduction at the turn of the century relative to average earnings, which is the right way to think about how ambitious a minimum wage policy is. And what you can see is it was introduced at a lowish level compared to typical earnings, so 45%. There was then a phase in the middle of the 2000s when the Low Pay Commission, under some encouragement from the Labour government, but was gently increasing the ambition of the minimum wage. It then plateaued during the financial crisis, but then since 2016, thanks to George Osborne, has been increased very fast. And the UK has been increasing it faster than anywhere else in the developed world, particularly if you look over a 5-year period. The sustained rises in the minimum wage as the national living wage was introduced and then ramped up. and aiming for 60% of median earnings, which takes us towards the top of the developed world. The government's position is now to go even further and take it to around 66% of typical earnings by the middle of this decade. And the crisis, because remember, this is relative to typical earnings, all of which, all earnings are taking a hit from the crisis. So this doesn't change because we've had a crisis. It just means that the pounds and pence will be lower, but the relativity would be the same. So that is a huge deal. Just to put that in context, just focus here on the blue line. This is showing you the proportion of employees paid below who are on the easiest way. The way we define low pay in our work, and the OECD does another, is about what percentage of your employees earn below 2/3 of your typical earner. Yeah. And this blue line is showing you that has broadly been stuck at around 23% for most of the last 30 years. And that it's been falling now for the first time in 4 decades because of that ramping up of the minimum wage. So this is a very big change to our labour market and to our pay structures, as I'm sure lots of you are wrestling with. And that is very good news. And I think people probably didn't think that was possible a decade ago and have lived and learned that you can actually have very big rise in the minimum wage without employment effects, which is what the US government is now about to attempt to replicate over there. So where does that leave us? Well, I'll sort of then go on to 2 reflections. The first is to say that if you're thinking about your lower earners, and I don't mean just the very lowest, but your low earners, it's not just about hourly pay rates, even though that's all anyone talks about. And the second thing is that fair rewards aren't just about the low paid. And so I'm going to go through those both in turn to offer some thoughts. So first of all, on the low paid, what should we be thinking about? So the first thing to say is that it's not just about hourly pay, it's about hours. And this chart is showing you, again, lowest earners on the left, highest earners on the right. Who wants more hours than they are currently getting from their employer? Okay, and it is low earners. In fact, in general, loads of high earners want fewer hours because nowadays, unlike at the turn of the 19th century, it's actually the highest earners that now work the longest hours, whereas it used to be the lowest earners that work the longest hours. And that this is happening for a whole host of reasons, which is partly about how norms of hours setting and contracts work in our low-paying sectors, which have been traditionally female-dominated, and therefore have contract forms that tend to assume everybody is doing their job as a kind of, a top-up to their earnings rather than their main income, which obviously isn't true. But the numbers are very stark. And it's not just about the volume of hours, it's also about how certain you are about those hours. So this is showing you, just focus on the red bits of these charts, okay? It's showing you what percentage of different kinds of occupations, lowest paying occupations at the top, highest paying occupations at the bottom, are anxious about changes to their hours of work happening at short notice. And as you can see, 4 in 10 of the lowest earners are very anxious about short-term changes in their hours of work. And they are right to be, because if you look at and you do survey work or you do focus groups with low earners, they regularly have both one, short notice of their shift patterns. Some organizations give people a month's notice, but some give people just a week's notice of what their shift patterns are. And secondly, even if they have got shift patterns, at the moment, there's very little incentive to stop employers that don't particularly care about their long-term relationship with their employees from changing those at very short notice. Like, I won't ever get over being on a train coming back into London from Stansted Airport at about 7:30 in the morning. And a guy got on, sat down opposite me, sandwich in hand, and his train ticket, obviously. And then literally as he sat down, his phone went. And I obviously could only hear his part of the conversation. But he was basically being told not to come into London because he wasn't needed for work that day. And he explained to the person on the other end of the phone, he'd already paid for his ticket, he bought his lunch. And the guy said, well, that's interesting, but get off at the next station and go home because there's no work for you. And that is perfectly legal. And that is why people feel on some forms of contracts. And that is why people feel anxious about their volume of hours they are getting. This one is a bit more tricky, okay? This chart is looking at how regularly we pay workers, okay? Because I think in most public policy discussions I've ever been involved in, people assume everybody is paid monthly because that's what professionals are generally paid, okay? And Britain also is unusual in paying quite a large percentage of its workforce monthly. This chart is showing you, though, that if you just focus on the lowest paid, those are the dashed lines, actually at the turn of the century, almost as many, were paid weekly as were paid monthly. That was much more normal for them, and more were paid either weekly or 2 weekly than were paid monthly. That has changed significantly during the first decade of this century. Big shift of all workers being moved on to monthly payments. This happened for a whole host of reasons. Lots of them actually, not particularly well thought through. It was just cheaper, easier to run payroll once a month. My question I would pose for you is, when this change happened, were we thinking about what was in low earners' interests when we did it? Okay, because I'll tell you something. That same decade that saw the fall in weekly payment is the same decade that saw the rise in payday lending across Britain. Huge surges in payday lending. I'm not saying this is the only reason, because financial regulation had lots of things to do with it as well. But in a world where low earners are living on tight budgets, does it make much sense that loads of low earners are having to go and borrow money while, if I'm honest, they are basically lending money to their employers for large amounts of the month? I also have, I get once every 6 months now, I have some entrepreneur coming through my door telling me he's got a really cunning way to let businesses lend money to their employees against their earnings. You might have heard of wage stream. This is one of them. All of these entrepreneurs are reinventing ways of doing weekly payment, which we all used to take for granted. So I'm just offering this as a case study and a change I don't think people made intentionally to make low earners' life harder, but has had that effect, and wouldn't be that hard to offer low earners the choice of how often they want to be paid, given that in the end it is their money that they have earned, and we don't charge interest on earned wages, obviously. And then this is just to give you some broader background context. So I think it's important, which is when I talk to boards of big employers, I think we often think in terms of our employees, actually their incomes actually being mainly determined by what we pay them, okay? We think of fairness in terms of, well, I give them this money, that's what they actually live on. And I just want to make a point, which is this is showing you the change in income for different bits of the income distribution. The red line is since the mid-90s. The red line is showing you the lowest earners, the lowest income families. The blue line is showing you typical income families, and the blue bar is showing you the richer households. And if you look at the red line, they are basically now back at income levels that they saw at the beginning of the 2000s, okay? And the reason for that is mainly large benefit cuts over the last few years, since 2015. That's what's driving that big drop since 2016-17. Now, without going into the details of the benefit system, the system's just become less generous. That's why the Chancellor had to make it more generous during this pandemic. But the thing to think about is, if you pay your low earners an extra £1, yeah, and they're in a low income household, they only keep about 35 pence of that pound pay rise because they lose benefits. They're on a benefit taper, yeah? Their marginal tax rate via the benefit system is very high. And so in the end, I regularly, I don't think people clock, and this is probably a big deal for about 30 to 40% of the population, particularly your 30-somethings with kids, okay? This is not about just very poor people. 30-somethings with kids, even on decent-ish average incomes for the household, this is affecting them. So if what you care about is the living standards of your workers, you can't just think in terms of your pay. You have to know more about their family circumstances, and you have to care about what the benefit system does too. And then lastly, to wrap up, fairness isn't just about the low paid, obviously, although this crisis is about the low paid. So I just want to give you some context here. So this is showing you two ratios of earnings. The top one is showing you a version of what I showed you before, which is low earners versus the middle, okay? And as you can see, it's been falling broadly, coming down through lots of the recent years. But at the bottom, what I'm showing you is the relationship between the top earners, not the very top. So this is not about bored people. This is about people at the 90th percentile. So they're earning something in the region of like £50,000. £55,000, yeah, relative to the typical earner. And remember, the typical earner in Britain is taking home in the region of £30,000. And there has been very little change in that. That line went up a lot in the 2000s and has basically stayed put ever since. And if you're a middle earner seeing no pay growth, then looking and seeing your higher earners earning a lot more than you and staying higher during that phase is probably the default. That's probably what is dominating your view of fairness within the organization, which is that you thought that was okay when everyone was getting a pay rise, but given that no one's getting a pay rise because Britain's had a disaster for the last 10 years, I think that is more likely to be the dominant fairness point. So then, just to conclude, the crisis has been a disaster for lives and living standards for low earners, and it comes on the back of a disastrous pay decade, much worse than anything any of us thought was possible. The minimum wage has transformed things for low earners, but it is not job done when it comes to the low paid and all kinds of things, some of which are in the remit of government, but some of which are in the remit of firms. And while low earners have caught up with the middle is doing no catching up with the top. And in the end, that is where the new frontier of policy and thinking is going to come on fairness for pay in the years ahead, as well as thinking about the very top, which we're hearing about today. So I shall wrap up and leave it there.
Torsten, thank you very much for giving us so much food for thought there. So Peter and Torsten have talked us through the broad political, economic and social context and how companies are responding to these challenges. In a moment, Celia and I will then explore how those challenges translate into executive reward policy and practice, and how we might be able to address them to sustain and raise organisational performance. So I'm delighted to introduce Celia Baxter, who's now going to give us the Remuneration Committee perspective. Celia has a wealth of commercial, international business and HR experience as an executive. She's now the Senior Independent Director and Chair of the Remuneration Committee at Senior PLC, and also chairs the Remuneration Committee at both DS Smith and RH Magnesita NV. So Celia, would you like to share your perspectives with us?
Hi, thank you very much, and nice to be able to speak to you. Obviously, I'm going to be talking very much from the corporate perspective, and I think that the first thing that I would say, and it's been touched on by other speakers, that this whole element of fairness and reward is a very complex situation. One size does not fit all. And I think one of the first things is that I sit on 2 UK based boards, but a European board. And the whole element of fairness, it doesn't come up as much in the European board. And my experience from being an executive is that although I think in the US there has been more emphasis now on fairness and looking at the potential excesses of executive director pay, it still isn't at the level of looking at the intricacies of fairness that the UK and the UK press in particular emphasises. So I think that it needs to be borne in mind that is this a UK only issue? And if it is, what about if you're a business that's got international spread? Because if you've got international spread and you are ruled by these UK fairness regulations or ethos, then that can make that quite difficult for you. And so, for example, the CEO pay ratios that came in, the regulation says that you look at the CEO's pay ratio against your UK-based workforce. But it could be that your UK-based workforce, as is the case with one of my companies, is 100 people. And in actual fact, that means we don't have to report, because if we had 250, we would. But the rest of the workforce, if we had the 250, the rest of the workforce, the other 8,000, is outside of the UK. And therefore, what we're giving as a CEO pay ratio is not just about is it fair, it's actually wrong. So, you know, it very much is about fairness in the eye of the beholder. And I think the other thing about this, does one size fit all? It's interesting that a lot of shareholders will be talking about you must state your business strategy and how your pay fits in with your business strategy. But then we're forcing companies into a mould which says one size does fit all. And this is particularly difficult, I think, if you're in particular sectors like pharma and IT, where recruitment, it truly is an international recruitment market. And if you feel that you are going to be able to get an American executive into a UK-based business and be able to offer competitive and incentivizing rewards, it's difficult, and a lot of companies can't do that. So this is having a very negative effect. And another example of that sort of market sector and the way that fairness has sort of worked a bit of an opposite direction is one of the big pushes at the moment that probably everybody has been trying to tackle is the CEO pension alignment, aligning your CEO's pension contribution to the average of the UK workforce. One of the issues that gives you is that if you are a company that has got a very large blue-collar workers, a set of blue-collar workers, often if they're trade unionised and they're at the lower income level, then people are looking for disposable income, particularly often where it's trade union negotiated. They're not looking for big increases in pension contribution. So you potentially end up with CEOs of manufacturing companies or security companies having much lower pension contributions than people from, surprisingly enough, the ones that probably created the problem, banking, still having the higher pension contributions. So you have a real mix of, well, is this really fair? And does one size fit all? And why is it that this all appears to be focused on the UK PLC? What about fairness for the pay in private companies or in partnerships or private equity companies? This seems to be a real push for the PLC, and that in itself causes problems in terms of recruitment, retaining people and attracting people in. Wouldn't it be nicer to be the CEO of a privately run company and not have your next door neighbour looking at the total intricacies of your pay package? How many people feel it would be fair to display their pay package to their next door neighbours? So I don't think one size does fit all, and trying to force it, is that fair? But can you be creative and do something which is outside of the box? And I think that there's a lot of things that need to be considered with that. I think you can be creative, but in being creative, you need to be able to sort of consider a few things. What your share register looks like does in actual fact give you a little bit, it will give you a hint as to what you may be able to do in terms of things that are a bit out of the ordinary. So if your share register is a lot of American shareholders, my experience has been that when I've gone through a policy consultation and it's about quantum increases, I'll often have a conversation with a UK-based shareholder that is sucking their teeth about the quantum, and I talk to my American shareholders and their first reaction will be, are you paying enough? And because it's just a different viewpoint. But if you are lucky enough to have a shareholder base that has got a more lenient view and is not so hidebound by IA's view or ISS's view, then it gives you a little bit more wriggle room. The other thing that gives you wriggle room is, to a certain extent, your board structure. I sit on one board where I have two key shareholders on the board, so they actually control 40% of the shares. And so if you actually consider that probably only 75% of your share base vote, it means that we can be a little bit more adventurous on what we want to do, because it is likely we're going to be able to get a good vote, even if some of our standard shareholders will vote against. And that has been the case with a situation I had on that board last year. So board structure does matter. There's also the whole thing about risk appetite of your board and your remuneration committee, is that in any other circumstance, if you look at passing a test or a vote, you'd be quite pleased with 80% or even 75%. So why do we care if it's under 80%? Yes, we have to go on to the naughty step, but does it matter? Particularly where it's the remuneration report, where it's a non-binding vote. And even with the policy votes, a lot of the time, that also doesn't matter that much, in as much as some of the changes going through recently, if the policy is voted against, the previous policy was worse because you didn't have the best practice in it. So I think that sometimes the remuneration committee can get a bit too hung up on we need to be in the 90s. I think the key for me is about having the clear alignment to your business and being able to articulate why you are doing something, why it doesn't meet the norm, but why it's right for you. And if you feel that that is the case, I think you can be creative, but you are going to have to be very clear. You're going to have to communicate very well with your shareholders, and you're going to have to engage very early. And you will have to realise that you are likely to get votes against, because different shareholders have different views and one size there does not fit all. So what is a fair reward system? Well, Peter is the expert on this, and he's mentioned a few things about this, and I just wanted to add a few things in. There is pay, and I've been dealing either as an executive or a non-executive in implementing pay schemes and living with my colleagues that have then had to put up with the pay scheme. And things go in phases and trends. And so at the moment, there are some companies that talk about, well, we wouldn't have this problem with high pay if we only had fixed pay, because most of the problem is around variable pay, which is, I think, what George said at the beginning. But if you have just fixed pay, all that's going to mean is inflation on fixed pay. And if this is a UK problem only, how are we going to be competitive if we're trying to attract people in? The other thing that some companies have done to get rid of the complexity is to have one incentive scheme and therefore drive everything off the annual bonus. But for me, that feels a bit strange, because I think it loses some of the ability for the long-term incentive plan to be retention based, because if you don't hit the targets in the year, you don't have anything to then hold on and retain. And so I think it becomes a bit more of a blunt instrument. And restricted stock, we've had a few comments about that, and it's interesting. I think restricted stock, as Peter said, there's two opposing views about it, but I think that most businesses that feel that they are going to outperform don't want restricted stock, because they can see the leverage of, really blowing the lights out. And it's likely that if you're sort of you haven't got a particularly ambitious management team, they may well want to have restricted stock, because it's going to pay out whatever. And to me, and for some shareholders that I've spoken to, they see it as encouraging mediocrity. And with one of my companies, which has been really hit by the downturn, any thought of putting restricted stock in would be seen really negatively, because what the shareholders are looking for is recovery and big growth in the share price. And if we went forward with the restricted share plan, that would be seen as sort of a bit of a surrendering, that we don't think we're going to recover. So I think you've got to be very careful about when you might want to put some of those things in. And so you can come up with your creative plans, and there are all sorts of the best practice that has been brought in, but there is the whole element of trying to implement these with your executive directors, and all of us will have suffered from some of the things that we have seen coming in to, in actual fact, try and increase the fairness. And I touched on the pension contribution. I think that for incumbent CEOs, that has been a really difficult situation. A lot of them see that, and it's correct, that a reduction is breaking their individual contract of employment, which was agreed when they came in. No problem about it for new people coming in, but why break my contract? I've mentioned as well that if we have problems, I think, in attracting people now into PLC roles. I think PE has become a lot more attractive, and we've seen some recent companies going private. I think Agreco was the last one we saw. I would imagine quite a few of those executive directors are potentially elated that they will be going private, because it just gives them more flexibility. And I think the other thing that one of the things that's happened over really the last probably 10 years, and it's probably could be connected to this, is that there used to be normally more than 2 executive directors on boards. It was seen more as a US thing that there were 2 exec directors, whereas in the UK there were often the ops director, divisional directors, they were all exec directors. That's not the case anymore. In my view, a lot of that is because of the amount of disclosure and the fact that it prevents the flexibility of being able to pay people in the way that you want to pay them. And I've mentioned international competitors, and I think the other potential issue is if you are trying to implement some of these things that are very UK specific and you're an international company, not only, I think Peter mentioned the sort of separation of executive directors' pay from pay lower down in the organisation. But I think as well, you get the potential that you are having separation of your regional MDs, because you're going to have to then put different things. I mean, there's always an issue about long-term incentives and stock programs for the US. Most UK companies with US businesses don't really want to put different quantum in, but the more these restrictions come through, the more likelihood is of having to have those slightly different plans in different areas, which potentially causes problems and inflexibility in being able to relocate your people into the parts of the business that you want to relocate them into because of the changed structures. So, I think I've been terribly negative about what's fair. Hopefully not too negative, but what do I think is going to happen? What do I think we're going to continue to see? I think that we are going to get more questioning of what is fair and equitable. And I think it's right that we do have that questioning, because I do think that some of the things that have been tackled have been correct. I never did see why management and above should get a higher annual pay increase than lower down the organisation. So for me, that's right. Pension contributions, once again, I think that's right. What I don't agree with is going and trying to batter down what has been agreed previously. But I do think it is right to look at it But we do need to make sure that whatever is put in place doesn't have unintended consequences. And the other thing which Peter has mentioned, and I've seen it in the time, I've been a Remco chair now for 7 years, and in that 7 years there has been more and more discretion required of looking at the outcomes and of bonus and long-term incentive, and that is particularly going to be in 2021. And I think that is still going to be the case. I think that the discretions in the main, well, first of all, are going to be downward. I actually feel that if you've done some downward, I would do some upwards if I felt it was appropriate. But I don't think I would feel able to do an upward if I hadn't done a downward, because I just don't think that the shareholders in the market would take it. But I do think discretion and the Remuneration Committee really looking at what makes sense for the business. And just a final point about it, I've come from one angle at this, but George, I felt, had quite a cynical view about remuneration committees and aren't we all buddies together keeping the pay up. And one thing that I would say is that it was very difficult to set targets last year on bonus. But one of my companies, when the bonus results, the outcome came, we had waited a while to set our targets. It had been difficult to set them. And the outcome, we were over maximum on both of the targets. But that management group came to the Remuneration Committee and actually said, we shouldn't be paid the maximum, we feel we should be paid at target. So they came and took a 50% cut. It wasn't me having to push them. So I think that it can be a little bit more self-regulating.
Celia, thank you so much for that. What I'd now like to do is, if you'd been able to watch me while Celia was talking, I was nodding vigorously in agreement. So I'm not going to repeat and reinforce many of the points that she made. But I thought I would just try and complement it by just talking briefly to 2 slides, which I think just give you perhaps a slightly sceptical view of how committees are made. And you guys all know this, but I think it is worth just reminding us of the context of how remuneration committees do make decisions. So this is a sort of stylized chart that just typically shows up to 8 parties who may be represented in the Remuneration Committee room whilst the decisions are being made, or who have influenced it outside. And you should take on this that the Group HRD is also a proxy for the Group Reward Director or the Head of Reward. It's the professional on the payroll internal advice about reward matters. And the 4 key players, and I hope Peter will forgive me for leaving them out as not being a key player, the 4 key players in the decisions are shown here in dark blue. And in my experience of remuneration committees, where it all starts to become dysfunctional is if any of those 4 parties, but particularly if any of the 3 on the left, become too powerful a voice in the debate. There needs to be some self-checking and regulation going on between the Remco chair, the CEO and the board chair. So if we can move on to the next slide, here's a very cynical view of how these, what are the interests that each of these people have at heart. And in the little box next to each of the protagonists, I've shown what in my experience is often a particular preoccupation that they have. So if I start with the CEO, I think virtually all CEOs are focused on their earnings. I'm a great believer that why would you expect your chief executive to be a great negotiator on behalf of the organisation and not be a great negotiator on behalf of themselves? So they're often very skillful at disguising that, but I think their package matters to them. They're also worried about the motivation and retention of their direct reports, so the other executive directors. And what I've also seen quite a lot of is the tendency to say, well, Alan, I'm not worried about this, but I am worried about it on behalf of my direct reports. So there's often a way, in that very British way, of sort of displacing the tension. The Group HRD brings enormous technical expertise to this debate. I mean, you have to remember that us Remco chairs, we are part-time amateurs. So we don't do this all day, every day. We try and take it very seriously, but this is technically challenging stuff. And we are very reliant upon wise counsel, objectivity, and good information from both the internal resources of the group HR team and also our external reward consultants. So in my experience, where it can go a little bit wrong with the group HRD or the head of reward is that, of course, they are on the payroll. They are subordinate to the chief executive. And in extremis can be a little bit worried about their job security. But I think in my experience, that's almost always more than balanced by a strong sense of professional integrity and wanting to get the right reward structure down through the organisation. The Remco chair, basically, above all, you're trying to get an agreement. You're trying to get something that works within the Remuneration Committee room, that will fly with the shareholders, and that it isn't going to saddle you with uncomfortable precedents for the future. And the board chair, I think, is clearly worried about boardroom harmony, because we all know that the Remuneration Committee chair can be the least popular job in the boardroom, but also is the last thing any board chair wants is a row about remuneration of itself, leading to the departure of a chief executive or even the departure of a Remuneration Committee chair and needing to go out and do a piece of recruitment. So I think in my experience, where the landing zone is to get sound decisions made in remuneration committees is the white box in the centre of this slide, which you can argue with these things, and I've tried to put them, I think, in rough order of priority. But I'm reminded of really what PARC stands for, which is about the link between performance and reward. And I mean, this is about rewarding performance. And I think what any remuneration committee chair at their peril would not want to preside over is rewards for failure. And we all know that there's been some examples of that in the past. I think you are wanting to make sure that your shareholders will support you. I accept and totally agree with Celia's caveat about the 80% naughty step. As my chairman in one of my roles keeps reminding me, you could do some absolutely draconian things to a company with only a 75% vote. So why are we suddenly saying that 80% is the new standard? So I think with that, I would like to draw this particular input from Celia and myself to a halt. And so for this final section, I thought I would just give each of the panel members a 60-second opportunity to, with any immediate reflections and reactions they have to what they heard from the other three. So, Peter, can I just start with you?
Thank you, Alan. Yeah, I loved it all. I was riveted. Something that Torsten was talking about is really interesting. I have the distinction that I'm an exec pay consultant who helps to run a church on a housing estate. So I know people in that top 1% and in that bottom 1%. And I think one of the problems we have as a society is people on low incomes and benefits do not have a voice. They don't have a voice within HR departments, which leads to the removal of the weekly pay going to monthly pay. They don't have a voice in Westminster. I wasn't surprised by Brexit, because I know some ordinary people who are not in a business media elite. So I think that point about trying to get that voice heard by policymakers and by HR teams is a really important point. A couple of things that Celia said were interesting. Just this idea. I think sometimes the governance people forget that senior leaders in businesses, CEOs, CFOs, have got the normal motivations that we've all got. As you said, Alan, they want to be paid more. Of course they do. They don't want their pay to be harder to earn. They don't want their pay to be deferred forever and they can't spend any money until they die. Those are not good things to look for. And so I think it was a useful corrective from you, Celia, to say, actually, we need to hire talented people. Now, industry has cried wolf before about some relatively benign changes to executive pay, but I fear we're parting company from what happens in the rest of the world and in other forms of ownership.
Peter, thank you for that. Torsten, your reflection on what you heard from the three of us here in the room.
Was a long list of interesting things. Maybe I'll just offer two thoughts, which all come down to versions of complexity. So on the from Celia and from Peter, the reality of how complicated the job is of Remcos these days and the number of inputs they're trying to balance. I think another way of thinking about that same issue is just there isn't a right answer. Okay, there's not a God-given technical spreadsheet given right answer to setting pay for anybody. And in the takeaway from that in big picture terms isn't that you should give up, obviously, because you should try your hardest to take into account as many of those factors as possible, but it is that social norms matter. Yeah, it's that there's not economics doesn't give you the answer, okay, on its own. That is not the only question. The social norms matter, and you can see that because when Celia was making a really interesting comment about how fairness gets raised on UK boards at the moment on remuneration committees, but not in the European context. Well, one of the reasons for that is because the stretch between bottom, middle, and top is so much higher in the UK, and that is because of what largely most of that shift is a feature of, first of all, of the late 80s, early 90s, and then of the 2000s, and that I think the public consent for that was stronger when you were seeing fast income growth for everybody. So in the 80s, everybody except the bottom saw pretty fast income growth. And in the late 90s and early 2000s, most of the population saw fast income growth. But since around 2005, we've seen little income growth in the UK. And it's in that context that people are then questioning the level of stretch between bottom, middle, and top that you are seeing, and that is why you're getting different debates in different countries, and there are norms. So like the gap between the top and the middle in Germany is just lower than it is in the UK. Now, one of the effects of that is that you have a higher concentration of Germans running German companies than you do having Brits running British companies in the UK, and clearly competition is a real thing, but you can't ignore social norms, is what I'm saying. In the end, spreadsheets don't give you everything you need to know. And then just on the pensions question, because Celia made a really interesting point about one, it's better that we've moved towards taking into account not having completely separate systems for top pensions and everybody else. That's a toxic way of looking at your systems. I think one thing that we don't discuss enough, but that is different between the top and the population as a whole, is that we talk about the move from defined benefit to defined contribution pensions as if the main issue is the reduction in the level of the pension. Yeah, I think one thing we don't talk about enough is that what's really changed is where risk lies. And so we've now passed to the individual not only the investment risk during the time they're saving, but almost all of the longevity risk. Now, maybe it makes some sense for the individual to bear some of the investment risk. It is nuts as a society that the individual bears the longevity risk, i.e. in retirement, of their pension pot. It makes no sense. It's like the opposite of all collective risk pooling economics that exists. And I think a bit more focus on understanding that for some of our lower income households, for their pension, the risk level that they are taking with it is a bigger problem. I may not think it is, but in practice is a bigger problem maybe than it is for our very highest earners, where in the end, whether their pension is delivering exactly the amount they hoped is not going to tank their living standards in retirement.
Thank you for that. I know Peter wants to come back to that, but I'm just keen to give Celia her chance to comment on what she heard from Torsten and Peter.
Thank you. Well, one thing that I wanted to pick up was, I think it was Peter that talked about what's happening in the future and talked about ESG measures coming in. And I suppose I've seen a lot of interest because it seems to be the topic of lots of seminars. I also have seen a lot of my colleagues that are other RemCo chairs putting ESG targets in. But I suppose I'm still in the camp of saying I think that we shouldn't do knee-jerk reactions on this because ESG is once again quite complicated, and are you putting measures on E, S or G, and what are going to be the unintended consequences? And do some of the performance measures for particularly environmental, which are much more long-term, fit in with either an annual bonus or a 3-year LTIP? And I was also interested that when I was consulting with shareholders with one of my companies this year, there we have only financial targets within our bonus, and one of the shareholders particularly was we do have the facility to put strategic measures into the bonus, but he was very much wanting us to even take that ability out of our policy. And when we said, well, we're thinking we might do something on ESG, not this year, but in future years, he was really saying, well, we really don't want you putting those in. And once again, it was one of those things that I think it depends on where you are in the cycle. And there was a whole phase of people wanting strategic targets into the bonus, but I think that there is now some jaundicedness that that's a way of paying the bonus. And I have heard some people telling me that the way that incumbent executive directors' pension contributions have been reduced is because they've been semi-guaranteed that they will get their personal bonus targets. So I think that we need to be a little bit careful on rushing to do some of those things. And I was interested in Alan's comment about the job security on the HRD or the head of REM, and saying that job security was one of the issues. I was pleased that he countered it because I was a group HR director, and I never felt any concern about job security when I said what I felt was correct, and therefore I haven't encountered that. And I do think that those people in that type of role, that is part of the role. It's the same as an FD, where the FD is there to call out any fraud, and therefore I would not see that as being a big part of it.
Okay, well, I did say I was being provocative, so I succeeded. Peter, you wanted to just come back to Torsten, I think, on pensions.
My background is I qualified as an actuary before I became a REM consultant, something that I've never regretted as a change. But when I became a reward consultant, suddenly I had access to senior decision makers in companies, heads of HR, CFOs, CEOs, and the like. And it was interesting exploring with them this issue of risk. And just looking at the conceptual model that Torsten described of, well, could the company keep the investment risk and pass on the longevity risk, or could the company keep the longevity risk and pass on the investment risk? And in both cases, there was a throwing up of hands in horror that we couldn't possibly take on such a risk, seemingly ignoring the fact that they'd had both of those risks all along. And so actually moving to an environment where you pushed one of the risks out and kept the other. They weren't prepared to countenance it. And then I had a conversation that said, well, could we radically cap DB pensions? Could we have a DB pension where the pensionable salary is capped at some very low level, so you can get your 40/60th or whatever of 20,000, and above that you take your chances with the stock market on longevity risk? And again, the view was, we just want out of the insurance business altogether. We want to pass on all the risk and have a clean accounting charge. I think it was an historic mistake, actually, not to find a more creative way of doing this.
Yeah. I couldn't agree more. I've got the unenviable task of trying to sum up what has been an extremely wide-ranging debate. Well, first of all, you all know that nobody told you that the job of being a reward director or a head of reward was easy. And I think, if anything, the last 2 hours have illustrated that. But I am a believer that I think we've made, as a society, we have made quite a lot of progress in grappling with some difficult issues. I think there are still questions to be asked about absolute levels of executive rewards and whether those are justifiable. But as Celia pointed out to us, there are other choices for executives. There are international comparisons. There's the lure of private equity. So we have to beware of the unintended consequences of unfairly penalising those executives. Where I think we've got a lot more work to do as a society is, I remember actually Peter ran a very good event just before lockdown, and one of his guests was from a well-known prominent asset manager, and we were talking about the issue of executive pensions, and she said, our aim is not in itself to necessarily reduce executive pensions, it's to raise the pensions of the rest of the workforce. That's the bit that I think, and I guess this is the levelling up agenda, I think all of us need to do more work on, which is how can we create the wealth through appropriate incentives and rewards for high-performing executive teams that will create the performance whereby we can then more fairly distribute rewards through the rest of the organisation. So on your behalf, I would like to thank Celia, Peter and Torsten for being such great panellists. They've been very open, shared a lot of important thoughts with us. And of course, I would like to thank the hard-working team here at PARC, who once again have laid on a great production. So thank you very much indeed. Good night. Enjoy that glass of wine.